Good afternoon. My name is Peter Hartley and I'm the George A. Peterkin Professor of Economics in the Economics Department at Rice University, and also Rice Scholar in Energy Studies with the Centre for Energy Studies and the James A. Baker III Institute for Public Policy at Rice. And I'd like to thank you all for joining us this afternoon. I have with me Kelly Neill, who's a PhD student in economics, supported by the Centre for Energy Studies.
Hi everyone, it's great to be here.
And I also have with me Michelle Foss, who's a fellow in energy and minerals in the Centre for Energy Studies at the Baker Institute. Let Michelle introduce herself. Say hello.
Michelle, you're on mute.
I'm on mute. Thanks, Peter.
Okay. This is one of the second of our webinars in the series on CES graduate and postdoctoral fellows who are working on research sponsored by the Centre for Energy Studies. And we would like to thank the Centre for Energy Studies for giving us these very valuable webinar slots that they've used very productively for lots and lots of seminars, and we're using a few of them to talk about our students' research. And I'd also actually, as a economics department professor, I'd like to thank the Centre for Energy Studies for its very generous support for our PhD students doing economics, energy research, energy economics research. These students also are teaching assistants for our Master in Energy Economics program. It's joint between the Centre for Energy Studies and the Department of Economics. This is quite distinctive as a program in energy economics. It focuses on teaching economic, financial and other analytical tools to professionals in the energy industry. And for those of you in the audience who might be interested in the degree, please go to our website in the Department of Economics, where you'll find details about the Master for Energy Economics program. I'd also like to mention in the preliminaries that the webinar this afternoon is co-sponsored by the International Association for Energy Economics, which is the largest association for professionals specializing in the field of energy economics. Publishes two professional journals, the Energy Journal and the Economics of Energy and Environmental Policy. Also a newsletter, holds conferences and virtual presentations like this one, along with a host of other products and services it provides. You can find out about the International Association for Energy Economics by going to their website, www.iaee.org. For those of you in the Houston area, there's also a local Houston chapter that has met, and we hope will soon meet again if we have face-to-face meetings. Has monthly meetings that are held in the Houston branch of the Dallas Fed on Allen Parkway. So those of you interested in energy economics would like to come and talk about energy economics issues over lunch, please check out the Houston branch website of the IAEE. The webinar is being recorded and will be available at the Centre for Energy Studies website and also the IAEE website. And if you want to ask questions, you can use either the Q&A panel or the chat panel. I've got them both open and we'll be monitoring them and be looking for questions on there. So please feel free to start asking your questions as soon as you think of them. With those preliminaries out of the way, I'm going to turn to Kelly and ask her to please tell us what her research is about.
Thanks, Peter. So my research is about the natural gas market in Australia. So specifically, I'm focusing on the East Coast domestic market. I just want to point out that the East and the West coast in Australia have separate gas markets because there's no pipeline connecting them. But anyway, so my research so far is about how does this domestic market work and what is it that's driving prices.
Okay, and of course the other thing that everyone, particularly in the United States and around the world, heard about is Australia, with all these new projects, has become one of the biggest, if not the biggest exporter of LNG, for temporarily anyway. I guess Qatar has got a big expansion underway. But there's lots of discussion about how the LNG trade, connects global gas markets and may affect how global gas markets work. But there's been less discussion, I think, about what it means for domestic markets in exporting countries. So maybe, that's something I think our audience would be interested in, is what is the big expansion of LNG in Australia meant for the Australian gas market?
Yeah, that's right. So Australia's exported since the early 90s, but that was all from the West Coast, and they're still exporting a lot from there. But what's happened recently is that 3 LNG terminals have been constructed on the East Coast, and the gas being fed into those terminals is a lot. It's more than twice as large as the domestic use over there. So it's had quite a big impact. And it's connected the domestic market to the high value Asian market. And so with that, we've seen domestic prices increase in the last 3 to 5 years. But I mean, of course, the story is more complicated than this, but my opinion is that Australia should be able to benefit from opening to LNG trade and connecting to these Asian markets. But for that to work properly, we need a well-functioning domestic market.
Well, I might just add in there, of course, Kelly has also done research on the Western Australian gas LNG exports and how they have actually benefited Australia. So she might have, you both find some of her research on that topic around too. But
that's right.
But this is different because, as she mentioned, the East and West aren't connected, at least as yet. So there's been this big increase in prices, and there's been, I know, a lot of heated debate in Australia about natural gas markets, and and everyone's blaming the LNG. Is that kind of fair, or what else might?
That's right. So it has sparked a lot of political debate. People are worried that domestic users are paying too much for their gas because the prices have gone up. But and so that's put governments under pressure to do something about it. The other thing that's happened is not just the LNG question, but also renewed scrutiny about domestic competition itself, and that's what my focus is. So the background is that Australia has deregulated its retail markets for natural gas and opened everything to competition. That happened some time ago. And as part of that, they introduced daily auctions of wholesale natural gas in major cities. And so that's what my research is specifically focusing on. And I'm actually the first person outside of government and industry, of course, to try and look at these markets and see how well they've been performing.
So that's quite interesting. I think Australia is pretty unusual in having a market for natural gas at the local level. And the US has, of course, a wholesale market. But at this point, I'd like to bring in Michelle, and as someone from the US, and ask, do you think these develops in Australia are interesting? It's what Kelly's looking at. Yep, you're muted, I think.
That I didn't have a sound that would distract from Kelly's excellent comments. But listening to her, one can't help but think back to one's own long slog through getting a PhD done. And when I was getting mine done, we were reorganizing our industry and reorganizing our market. And so at the highest level, the most interesting thing for people who have looked at the gas industry or even participated in it through their careers has been to look at the countries that have taken similar steps. And Australia was always one of our benchmarks. Our systems are different, as Kelly points out. You don't have the connectivity between East and West. In the United States, our pipeline network is larger and denser and so on. But there are many more similarities between the two than everybody realizes, especially on this new question of how the domestic and export markets interact. Mm-hmm. So I think Australia is, first of all, it's always worth looking at. It's always worth thinking about. Mm-hmm. When it comes to gas, I think it's a fascinating marketplace.
Okay, so maybe I'll go back to Kelly and say, maybe do you want to give a little bit more background on these LNG projects for our audience?
So the most important for what I'm doing is the projects that are in Queensland, because they're the ones that are closest to the domestic market on that side. So they started operating sort of ramped up between 2014 and 2016. So those are integrated projects. They have upstream coal bed methane or coal seam gas fields, and then they own pipelines to pipe the gas up to the liquefaction terminal. Most of the gas goes to Asia, so around half of the gas from Queensland is sold to China, and the rest goes to Malaysia, South Korea, Japan, and they're almost entirely sold under long-term contracts. They don't, unlike the US markets, they don't actually appear to participate very much in the spot market. So in 2017, only around 7% of cargoes went to the spot market, and in 2018, that was 4%.
That's for these East Coast projects, although...
That's right.
Yeah, Woodside is talking about turning Northwest Shelf, of course, into a tolling facility. So because they're, all the contracts are basically over at this point. So, and I think there's a lot more of the LNG from the West Coast maybe going spot. But that does raise the issue, I guess. Everyone's talking also about the impact of US LNG exports on the markets, world markets for LNG. What Australian projects may also have some impact. I guess I'll come back to Michelle and say, how do you think about the relative impact of Australia and US LNG on world markets? And what do you think are some of the key differences and similarities?
Well, the first thing, of course, is that Australia has been one of the significant players to help deepen the marketplace, especially in the vast, huge Asia-Pacific basin. So that's really important, adding supply, adding liquidity. The other interesting thing about the Australia projects, because of news coverage of them, they've been so large, they've been visible on both sides, west and east. There have been so many issues. Maybe some of the Australian LNG developers don't want this recognition, but they've sure helped everybody understand the challenges of LNG value chain development, management, and project cost. And so we've all had, a lot of fun tracking on that over the years. For the US LNG developers, we all started looking at the possibilities in the Asia Pacific marketplace when oil prices were higher. Mm-hmm. So Woodside and Gorgon and, all of the major projects on the West Coast and even Queensland all birthed at a time when everybody was looking at Asia customers paying upwards of $16, 18, maybe 19 at the peak per million BTU. From the US perspective, that looks pretty darn good. And we'll get to this eventually, I'm sure, but these days it's a completely different picture. It's tough for US LNG to compete with Australia. So I think you guys out there, have an opportunity to really help build the marketplace in your part of the world in meaningful ways, commercially, price-wise, and contracting-wise, because you're there, you've got the advantage and the customer relationships and all of that.
I guess the other thing is that a lot of the Australian projects, or the firms doing them, US companies anyway. I mean, that's the other big difference, I would say.
Some of them are, but not all of them.
But you've got the Chevron and Shells, and I suppose we think of Shell as European, I guess. But
yeah. Don't forget Santos and Origin Energy.
Yes. But I mean, I think there's a difference if you think about Australia and the US with private firms doing the LNG versus national oil companies, let's say, doing
right.
Absolutely, and it's still an education. It's really been something to watch.
Mm-hmm. And maybe I go back to Kelly again. I mean, so we've spoken a little bit about the impact of LNG on exports from Australia on the world market. What about saying a little bit more about the domestic market implications of that?
For prices?
Yes, and prices and also something about physical flows. I guess how's it affected the sort of trading of gas, natural gas in Australia?
Right. So for physical flows, you can see in the data when the gas is flowing up to the LNG plants in Queensland and when instead it's flowing down to the domestic users down in the south. So you can see that there's more gas flowing to the LNG terminals during the winter of the northern hemisphere when Asian demand is high, but then in the converse, when it's summer in Asia, it's winter in Australia. So that allows the LNG project operators to sort of manage seasonality on either side. So they've got quite a good deal with their managing the two sides of those contracts. And so what's actually happened is that the domestic gas users have signed long-term contracts directly with the players involved in the LNG projects, and those long-term contracts are equivalent to about 40% of gas use in the domestic market. So they're actually supplying quite a big chunk of domestic use, and that's sort of become necessary over time, as the original sort of main source of domestic supply used to be the offshore fields down south in the Bass Strait, but that supply has been declining over time as our reliance on the gas coming from the LNG plants has increased.
Yeah, so there is obviously, I just had a question here from Michael about some other sources. I mean, apart from the Queensland coal seam gas, of course, you've got Central Australian natural gas in the Cooper Basin, and we still have natural gas in Bass Strait. So, and there's a little bit of New South Wales.
But really, like the largest two sources is still like currently the Bass Strait, but also Queensland gas. The stuff coming out of Moomba is significant and steady, but it's smaller than the other two sources from the data.
Had expected, I think we're going to talk about this later, but people had kind of expected a lot more of the coal seam gas to be developed, including in New South Wales, and also more conventional onshore gas in Victoria, but we've had another aspect of all this is there's been some kind of constraints on development, but maybe we'll come to that later. I'm not sure.
Sure, we can talk about that later if you like, or we can talk
about it now if you want to too. But
so what's happened there is that in the southern states, particularly in Victoria, there's been restrictions on development of onshore gas. So some states, including Victoria, have had outright bans on everything. So from this time next year, they've started to allow conventional exploration and development onshore, but not unconventional. And there's also been onshore projects in New South Wales that have had some political opposition. So I understand that project, if it's developed, would supply about half of the New South Wales state's gas demand. And it seems to be moving forward now, but it's had significant political opposition. So that has sort of reduced the availability of natural gas in the southern states where most of the demand is, and in turn raised reliance on the gas coming from Queensland that's associated with the LNG plants.
Yeah, so I mean, the other thing that happened, of course, is we had a pipeline built connecting the Northern Territory into Queensland. So that's another source of gas for the eastern market.
Yes, that's true. And there's some expectation that might increase in the future. But right now there is some supply coming in, but it's a relatively small source of supply at the moment.
And so getting back a little bit, I just wanted to pick up on this point, sort of backing up a little bit, your comments about the seasonality. It's something that people don't often think about if they're not from the Southern Hemisphere, that the seasons are reversed. So it does give Australia a little advantage here, that there's, as you mentioned, there's been increasing demand for increasing flexibility in LNG contracts. One element of that is seasonality, meeting seasonality and demand. And so one thing the Australian projects can do is they've got more to export in the Southern Hemisphere summer, which is the winter in the Northern Hemisphere, which is when the people want it in Japan and Korea. Conversely, when they don't want it in Asia, it's available for domestic use in the southern states, particularly Victoria. So do you see that reflected in the physical trades and prices?
Yeah. So that's what I was saying before. You can actually see in the data that when it's winter in Asia, summer in Australia, the gas is flowing and up to the LNG plants to be exported. But then when it's winter in Australia and summer in Asia, it's mostly flowing southward down to where the demand is when it's cold down in Victoria.
So,
can I ask a quick question about that, Kelly and Peter? I'm curious about this because aren't you also in Australia developing your own healthy share of gas-fired power generation, and that would create a little summer peak, wouldn't it?
Yes.
So my understanding is that so over the next couple of years, the AEMO, which is the person that's operating these markets, are anticipating gas demand, gas power generation to actually decline a little bit over these next couple of years, and that they associate that with increased interconnections between the state's electricity grids and also some large-scale solar plants coming online. But then, of course, once you have increased solar in the grid, you require gas for peaking to firm up the availability of electricity to keep it reliable.
Particularly in a dry continent like Australia, where you don't have a lot of hydro.
Yeah, that's right. And so they anticipate an increase in gas power generation sort of after the initial decline. And so we're actually seeing power plants being converted into peaking plants from baseload.
So there is a story here, which is, a lot of people in Australia, I think, are blaming LNG for high prices. But, there are other things going on. The upstream, the constraints on upstream development, the pushing renewables into the electricity system, which is increasing the demand for gas-fired generation. The sort of the sparse pipeline networks limiting the ability to bring in gas from Western Australia to the east, particularly, and so on. So there's a lot more going on, but still the export projects get blamed, which I guess I'll bring Michelle back under that because, I mean, do you think people in the United States are going to say the same thing if the US projects we get a lot of them off the ground? Are we going to get the US domestic prices affected by LNG exports, and people are going to blame that maybe for price increases here? And of course, here you've got
why not? It's an equal opportunity.
I mean, it's maybe
so so I'm all in these. I always end up dating myself. So back in the old days, like 98, 99, when we were well into our open access, the popular thing for people to raise, those who weren't so happy about all of that, was that if depending on season and direction, if California sneezed, North Carolina would catch cold, or the other way around, because what everyone was worried about was what would happen to customers in this very interconnected system, including Canada, if you stressed one part of the system. And LNG just sort of adds to that. I was looking at, things to kind of catch up a little bit for this. We were sending out as much as 10 BCF a day at the peak before all of the, pandemic started. We're about half, actually less than half now. Yeah. But 10 BCF a day is a big part of the US market to be exporting. So the sensitivity to prices and things that are happening in other markets overseas, that's one consideration. The other consideration, of course, is you've got to have an attractive price for US gas to go into feed, which is another issue. And that one I think is going to be more interesting coming up over the next 2 or 3 years than the other way around. So, trade and liquidity help us for sure in terms of balancing all of these markets, but they also introduce new complexities. We have to be honest about that, I think.
Yeah. Yeah. So I think I should add at this point that CES, Centre for Energy Studies researchers, we've done some studies on the impact of LNG exports, and people can get hold of those studies on our website. Just to throw in another little ad for some of our work. But one thing we found is if the US exports more natural gas as LNG, of course, one thing that happens is that Canadian gas penetrates further south. into the United States. So kind of that limits limits to some extent the price impact, because there's a lot of Canadian gas that can also come in.
Yeah, I mean, one of the things we've succeeded in doing is creating a lot of fungibility in the U.S. gas system, the North American gas system, and a lot of things can happen when you create windows of opportunity. So.
Yeah. I guess the other thing that comes up with this discussion, and this gets back, I know Kelly did work on domestic gas reservation policy in the West, but the other thing that's sort of gotten some legs in the Australian debate is people starting to talk about restricting exports because of the price impacts. So, Kelly, I know you've done work on the West Coast, but what do you think about that idea?
Yeah. So I did study the Western Australia has a domestic gas reservation policy, and so they're thinking about doing one on the East Coast. So what the reservation policy is intended to do is divert gas that would have been exported and have it be supplied to the domestic market instead. And the intent of the policy is to raise domestic gas supply higher than it would be, and therefore lower the domestic gas price. So the best way to think about a policy like this is to think of it as it's equivalent to putting a tax on the exporting companies and giving a subsidy to the domestic gas users. Mm-hmm. And so neither of those policies, a tax isn't a good policy, and a subsidy also has adverse economic consequences. And so if you put them together, it doesn't make it a good policy. Yeah. So what I found on the West Coast was that the loss to gas producers is mainly that they have to sell their gas at a lower price onto the domestic market. But the gain to the gas users is that they can get cheaper gas than they would, and therefore they might produce a little more than otherwise. But when you compare the two, the loss to the gas producers or to the exporters is larger than the gain would be to the users. And so you end up with a net loss to the economy as a whole.
Good free trade economics.
That's right.
Popular thing right now to talk about. But
that's right.
And I think that. Do you think this sort of issue may come up in the US, Michelle? I mean, and also perhaps we can talk about not just LNG exports, but pipeline exports to Mexico, oil exports from the US. Do you think we might have calls for some kind of domestic reservation or not?
When we were getting ready for this webinar, I made the observation to Kelly, you could look at Australia, and Australia would be a really good example of domestic gas customers benefiting from LNG development, because it's actually created a push for gas development, right? Gas resource development. Mm-hmm. And in the old days, again in the United States, that was true as well. I mean, we for generations sent gas out of East Texas, Oklahoma, the Mid-Continent basins, the shallow Gulf of Mexico, up to the northern markets, upper Midwest and Northeast. What we've been doing, of course, is taking advantage of what we like to call free gas for our LNG businesses now. I mean, not so long ago, we were going to import gas, and everybody in Asia was worried about the United States being the swing importer, right? So that was like 2012. Yeah. 2012, all of a sudden we're swimming in gas because we've got associated gas coming out of the shale oil plays, and embarked on our export projects, as Peter pointed out, not just for our methane, but also for all of the light oil and everything else.
Because going back to your previous remarks, I mean, the deregulation of the markets in the United States also was a big thing, right? We're allowing markets to work.
Getting markets to work, and you could get out and you could reach buyers directly, and you didn't have to, have the pipeline, the interstate pipeline as a go-between, all of that kind of stuff. So, it's really interesting to think about how all of these things have unfolded. I mean, I don't think a lot of Americans know that we actually sell gas to the Canadians, because we've been cheaper than Western Canadian gas for a while now, at least, from the Appalachians. And as Peter pointed out, we've been selling gas to Mexico. We're actually now piping more gas to Mexico than we're sending out in LNG.
Mm-hmm.
So, you know, these things all are a matter of what the basis is, as we say. What is it that you have to pay for the gas? We're Henry Hub. And I think for the future, as we look at how the domestic and international markets interact, the big question is, we are going to lose gas production. So everybody knows that. How much is still something that we're trying to figure out. But about this time next year, as all of the results, the outcomes from the lack of new drilling in the United States start to show up, we're going to have less gas to be available. Our prices will reflect that. A lot of folks are moving towards close to $3 or $3.50 at Henry Hub. This is becoming now something that people are thinking about more actively. Can US LNG compete with that price? Unlikely. If domestic customers are start to feel like they're having to pay that price at Henry Hub because of international markets, I've always thought things could get interesting around that. I mean, you know, Peter, politics and economics are two things, right? So perception is reality when it comes to what natural gas customers have to pay for their gas.
Talking about politics and gas, the other big issue, of course, is pipeline. And I know both of you could have something to say about pipelines. I might start with Kelly. The idea that the Australian markets become more dependent on northern gas,
right?
Has put some constraints on the pipeline infrastructure. And I know then I'm going to get Michelle to tell us a little bit about some of the pipeline mess in the United States as well. So there's another common feature of the two markets.
Right. So, yeah, so like you said, at the moment, gas is being transported, needs to be transported from the north down to the south. But previously, it was the other way around. The main source of supply was down in the south. So as this has changed over the last couple of years, the pipeline infrastructure has actually adapted to accommodate it at the moment. So we've had pipelines can go in both directions now, and some expansions of capacity as well. Access to those pipelines has been an issue, though. A lot of them are tied up in long-term contracts. What they've done is they've introduced a daily auction for unused pipeline capacity. That just happened last year. I understand that that's been happening in the US for quite some time now. But there are indicators that there will need to be some more investment in pipelines or perhaps storage. And there's even suggestions of people have proposed building import terminals, so regasification terminals to get around current pipeline constraints.
Sounds crazy.
So
it does, yeah.
It's a bit like Boston importing LNG, right, Michelle?
If only we could, right? As you know, Peter, some of us have stirred the pot a little bit on our problems in terms of selling to ourselves. So we have the wonderful Jones Act, which prevents us from moving our own cargoes in our own waters because we have to use American ships and crews and other things, and having more flexibility in that would be nice. But when I was listening to y'all, as I'm listening to Kelly and listening to you all talk about things like limiting exports and banning exports, I guess my simple comment on the pipeline situation in the United States is that's effectively what we're doing. banning exports. The old rule of thumb in the pipeline business is that it's boring until it's not in the United States, which is most of the times catches everybody by surprise. So that is becoming a distinct factor in all of this. If we can't continue to ship gas out of the Appalachians into either domestic or international markets, if we can't exit as much gas out of the Permian as we would like, if we can't get gas out of the Rockies, that tells you what the future is going to be. I mean, opportunities for other suppliers, opportunities for other sellers. That's always what happens. Yeah. So
maybe at this point, though, I should get back to Kelly and give her a chance to we haven't sort of given her a chance yet to explain some of the details of her actual research, sort of on the daily wholesale gas auctions in Australia, and how do these auctions work, which might be interesting to to our American audience who, we don't have these kinds of auctions at the city gate level really in the United States and in many places.
Right.
And so maybe you talk a little bit about how they work in Australia and what some of the rules are. And
okay. So what they do is every day since 1999, there has been auctions for wholesale gas inside the city gates in four physical hubs. So there's Sydney, Adelaide, Brisbane, and a sort of a bigger hub in Victoria. And so each of those, there's an auction and a separate auction, separate price in each of them. So the aim of those is, the first thing is to sort of balance flows inside the distribution network so that the amount of gas going in equals the amount of gas being used. The second is to generate an informative price that can help direct investment. So Australia doesn't have anything like the Henry Hub, nothing close. And so this is helping. There's Wallumbilla, but it's not very, until recently has not been very liquid. Yeah. So in any case, so these are offering a price signal to gas users and gas producers. And the idea is to support the deregulation of the retail market. So we have competition in the retail market where you buy your gas from any company.
There's dozens of them, right? You can buy from in Victoria?
It depends on the state. So some of them, there's only some states there's only a handful, but I think Victoria is somewhere around 15. Retail companies. And then, so the idea is that because you have these auctions, any new entrant can more easily get access to easily get access to gas for their customers, and they have a visible price on what they're going to have to pay for it.
Okay. And what are some of the rules you're going to tell me?
So the rules are, so if you're a supplier in these auctions, you're somebody that has access to upstream gas and contracts for transporting that around the transmission network. So you're allowed to submit a bid into the market, which specifies at each price how much you're willing to inject into the hub. Some parties can also buy gas from the auction, so they can bid to say at each price how much gas they want to withdraw onto, say, transmission pipelines or into storage or into to use in their industrial facilities. But most of the purchases in the auctions are by retail companies, so they can't bid as such, but whatever gas their retail customers use that day, they purchase that gas via the auction.
Mm-hmm.
Yeah, that's all.
Yeah, as I thought. Yeah, so I mean, some of the debate in Australia, as well as the LNG affecting price, some of the debate is about whether these auction markets actually work, and are they sort of lack of competition or imperfect competition in these markets a problem? Is that causing some of the higher prices? What have you found out about how competitive in these markets are? How do they work?
Yeah. So when you look at these daily spot prices in the auctions, they actually do move together with the LNG price. They don't swing around as much as the spot LNG price does, but they sort of move in a similar direction, but sort of a more smoothed out version. But in terms of competitiveness in these markets, there's three large companies, and so they have three-quarters of the supply into those markets, and so that makes it look like it's not very competitive, especially when you think that all of these firms, they're vertically integrated, so they have access to wholesale gas, so they sell gas into the markets, but they also have retail arms, so they're buying gas from the auction as well. So essentially, when they supply gas into the hub, some of it they're just supplying it to themselves. So there's also a number of smaller companies that make up the rest of it. But so on the face of it, it doesn't look as competitive.
So are they, normally when we see markets not very competitive, you end up with high prices. So is that what you're finding at
Yeah, so that's what's been interesting about this research, is that it's not necessarily the case that prices will be high, even though there's 3 large players dominating the market. And that's because on any particular day, the large players might be either a net buyer or a net seller. So the large companies, they have retail customers, and if their retail customers use a small amount of gas that day, but they are injecting a large amount, but the company's injecting a large amount of gas into the hub, then on net, they're going to be a seller in the market. And in that case, they'd want to use their market power to raise the price. But on some days, their gas customers might be using a lot of gas, but they might only inject less than that into the hub, in which case they need to buy gas from the markets. And so essentially what these auctions are the large companies competing to buy and sell amongst each other. And there's some large buyers and there's some large sellers as well. And what happens is that the overall impact on the price sort of balances out.
So would you say that we end up with an efficient outcome then after all, even though you've got large players, or not?
So the prices are the same as what would be in a competitive, or similar to what would be in a competitive market, but that doesn't mean that we end up with an efficient outcome. It still causes some problems, so that the large companies, they have incentive to trade smaller volumes than they would otherwise, than they would if they were competitive. So they're not buying as much as they would from the market. Instead, they're injecting it themselves at a higher cost. And so that makes them worse off. Yeah.
But we've still seen a lot of entry into the market. And so, is that because this imperfect competition still generates excess profits in some sense that attracts entrants, or why do you think?
So a lot of the entry, we have seen entry, and it's been since 2017, so after the LNG plants opened. So the kind of entrants that we've seen are large industrial users that want to participate in the spot market, or some producers. There's been additional producers enter the market. There's also been some additional retailers as well. But the impact of that might be unexpected. So we've had a sort of increase in the number of participants in the auctions. But I think that the impact of that, you might not expect it, because if you have all of these extra small players and they end up being buyers, then that means that the large companies must be sellers. And so the large companies sort of have somebody that they can sort of exploit now. So you'd expect them to take advantage of it and try and use their market power to raise the price. But on the other hand, if the small firms are mostly sellers, then the opposite would happen. The large companies must be buyers, and they would want to use their market power to try and lower the price.
Right.
So a small number of small firms could actually make the market outcome worse compared to the case where the firms are all large competing against each other. But if you have lots of small firms, then the extent to which large companies can manipulate the price is lower, so that would right itself.
Now, I guess your research is not finished yet, but I mean, overall, how well do you think these markets are actually working in Australia?
I think they're working quite well in terms of providing a price signal on what the marginal cost is for domestic gas. So a lot of people have sort of dismissed them, saying, there's this lack of competition, there's this vertical integration, and therefore we probably don't have prices that indicate the cost of getting the gas to the market. But I think that because the firms are large and vertically integrated, we are getting a price signal that's close to the cost of supplying gas.
Okay. Maybe this is why I should bring Michelle back into the conversation. She's been very patient there listening to this. I mean, what's the, maybe say a little bit about the US experience with deregulating the gas market, and then, maybe I'll given the time here, we might also pick up some more of the questions, I guess, Q&A.
Mm-hmm. Kelly, that was great.
Thanks.
Wonderful insight into what's going on over there. So in the United States, of course, by comparison, a couple of things. Our large customers went right along in with the unbundling bulk market for gas, taking full advantage of it, even exiting utility systems, which of course has been a bit controversial. When we talk about extending, we've had the side debate as we were preparing, extending the benefits of open access and non-discriminatory supply and use of facilities down to the retail level, meaning the smaller customers, the households, even small businesses and so on. That's never really gotten off the ground in the United States. And so, but the larger commercial and industrial customers have taken full advantage of the system. And as far as I've ever seen, no one has been able to influence price, which would be a point of comparison to the Australian experience. It's just, our system is different. You're constantly on bulletin boards. You're constantly nominating for pipeline capacity, acquiring supply on your own. The biggest problems for people is, pipeline capacity constraints if you're in a congested market or something like that. And that's been, overall the major consideration. So the large customers, it's been, fully open and to their advantage. The smallest customers, not so much. It's been very rare to see examples in the United States in which, at the utility level, for instance, they've experimented with this to try to give the smallest customers access in the same way that we've done it for electricity, for instance. Mm-hmm. And I have to say, in the ancient history of my dissertation, that was actually one of the key questions, was whether what we were doing at the interstate level, at the FERC, the Federal Energy Regulatory Commission level, to restructure the industry would find its way down to the states. And I had a negative answer. So unfortunately, maybe that was a premonition of some, but a quick, feedback from you for the audience would be interesting on this. In the United States, our gas industry historically has always been so fragmented, and even more so after we restructured. We have the FERC, as we fondly call it, and we have all of our state public utility commissions, and we have a lot of other stuff going on out there. Whereas in the Australian system, it's not quite maybe as noisy. Mm-hmm. There's regulatory jurisdictions and so on, and how the industry is structured, and I think those are kind of important differences when you look at how successful or not network industries like these are able to, experiment with different ways of doing things.
Mm-hmm. Kelly, I've had a couple of, I'm just looking at the questions here too. I've asked a few of them along the way, but there's been a couple mm-hmm. of people who are interested in where you got your data from. And this is publicly available.
Yes, it is publicly available. It's a bit of a pain to process it all yourself. But so my data comes
It is not publicly available, right?
Well, so my data comes from the AEMO, which is the Australian Energy Market Operator. They're the ones that actually run the auctions, and they publish every day all of the bids that are submitted and the prices that clear. There's some key information that they don't publish, which I am trying my best to get my hands on. In terms of gas flows, that's on something called the Gas Bulletin Board, which is also run by AEMO. Mm-hmm.
And then we've already had a few remarks on sort of the relationship between natural gas and electricity, but a couple of people was also asked a question about that. So, I think you've also noticed in your research a link between gas and electricity prices, right? So you might be able to say a little bit more about the relationship between gas and electricity in Australia too.
So I was saying earlier that the gas price follows the LNG price. It relates to like both the forward gas price, forward LNG price, and the spot LNG price. And so what we see is that the electricity spot price also follows the LNG price. So you'd expect that because the usually, especially when there's low generation from renewables and other sources, the gas producers are the highest marginal cost. Gas-fired power plants are the highest marginal cost, and so they're the ones that are setting the price. But what I found that's interesting in the data is that there's also a feedback loop that the electricity price is affecting the gas price. So what happens is the gas price is set the day ahead of the electricity price, and we have players in the electricity market are also in the gas market. So the bidders in the gas market, they own gas-fired electricity generators. And so they look ahead to the following day and they say, oh, tomorrow the electricity price might be high because I expect a coal plant to be out, or I expect the weather to be bad, so there's low generation from renewables. So what I'll do is I'll sell less on the gas market and save it to generate some electricity tomorrow. And so what that does, because they're supplying less gas to use it as electricity, transmits the high electricity price into the gas price.
Mm-hmm. So at the same time, we've got some environmental opposition to gas development. We've got environmentalists proposing wind and solar developments, which are actually increasing the demand for gas.
For which we require, gas peaking plants.
Which is kind of a bit of a mess, right?
Yeah, that's right. Yeah, so you see the usual pattern with high gas use in the morning peak to generate electricity, and also in the afternoon peak, the same as you would in other places.
A bit like here, Michelle, we've got environmentalists opposing some of these gas pipelines, at the same time pushing renewables, which is increasing the demand for gas for electricity generation. So
the working theory there, of course, is that you get a higher price by opposing pipelines, which benefits your renewable energy projects. Ha ha ha. But that's really, that's important for people to recognize. The renewable energy business in our low gas price environment that we've been in since 2007 has had a pretty miserable time of it. And so there's a consideration there. As Kelly, pointed out, gas and power are joined at the hip. And if gas is providing the backup and if gas is at the margin, then the better it is, the better everybody who produces electricity will be off. This is true for everything, actually, for nuclear, even for coal, So I've got some questions here. A few people asking kind of questions about other Australian domestic resources. Some of them Northern Australia. The Northern Territory for a while had a moratorium on unconventional development, but it's been lifted, and there are some pretty good prospects for shale in the Northern Territory. And we mentioned the pipeline connection. So I suppose you have anything comments on that, or it's a bit early.
Yeah, it's too early. It's too early to tell. But so the pipeline that they built recently is a small capacity at the moment, and they're talking about, should the rest of that shale resources be exploited, then they would expand that capacity, and it could come down to the East Coast.
Mm-hmm, mm-hmm. And then there've been quite a few. When we started off talking about LNG, and then quite a few people sort of asking questions about LNG markets. I guess your research, Kelly. You found that for the Australian LNG exports, they are closely related to spot LNG prices in Asia, particularly the JKM, but you also found that they seem to be related to the forward or the futures prices, JKM futures.
Yeah, so I think that's really interesting. If you plot the spot prices, the domestic spot prices, and you also plot the LNG, so you have to adjust it appropriately. You take the JKM, the Japan Korea market price, you subtract off the freight costs, and then you convert it to Australian dollars and the right units. Then you see that you have a LNG spot price that moves around quite a lot, and the domestic spot price moves around less. But if you do the same thing to the forward prices for the LNG exports, then you get a very close match. So what I think that's quite interesting. And the thing I can think of to explain it is that a lot of the domestic gas from the LNG plants, the domestic gas that's purchased from the LNG project operators, is under long-term contract. And a lot of those contracts are pegged to the LNG price. So I think that's the mechanism for sort of dampening the volatility of domestic spot prices.
So some people were sort of on the basis of that are talking about spot markets in Asia, but what your research is suggesting is that the JKM futures, I mean the long-term contracts actually are moving away from oil toward the gas.
I'm talking about contracts between domestic gas users and LNG plants.
Yes,
so I'm not about the LNG contracts with Asian buyers.
But didn't the ACCC also, though, I mean, that would suggest that as far as the exporters are concerned, that the JKM futures price is an opportunity.
Yeah, true.
Right, so their long-term contracts are kind of linked to that. And didn't the ACCC tell us some of the, they know the terms of the contracts, right?
They do. The ACCC has been doing an excellent inquiry, and they have said in there that some of the contracts that they've seen have been linked to the JKM.
Yeah, so we're seeing.
Interesting.
I don't know whether Michelle would like to kind of comment on that.
Oh, I just think that's interesting.
Yes. So I thought some of the audience may be interested in that. They've kind of asked that question. Let's see. And I suppose the big thing on all that is that we really expect US exports to make a big difference with the Henry Hub link, right? And the fact that the US projects are able to arbitrage so well between different markets, particularly with the Panama Canal.
One way to look at what we've done in the United States is simply that we've exported Henry Hub. That's it, period.
Yes.
I mean, it's just, it's out there. Officially, our LNG facilities are bidirectional. So price here is attractive enough. We could see cargoes come in. Prices outside are attractive enough. They go out. That was the idea in principle. We haven't seen it in action quite yet. But so Henry Hub has been probably the biggest export item from the United States in years. I mean, this has been the news thing, It's made it it's impacted LNG contracting. It's impacted fuel oils and competing fuels. It's impacted coal, right? I mean,
So another question we've got on Asian markets here is a sort of interesting one is the LNG market in Asia going to be upset by pipeline gas coming from Russia, particularly, I suppose? I don't know if anyone would like to comment on that.
Well, Australia sells to China, huh? So
yes.
Kelly and Peter.
That's right.
I mean, this is actually getting pretty real. Y'all ought to be able to start seeing that, I think.
Those are all long-term contracts. As of what I've seen, is long-term contracts out to 2035, though. So I'm not sure what would happen after that. It's a long time.
Yeah,
it's a long time.
Okay, and let's see. There's a question here whether CNG is taken off. Actually, Australia has for a long time used, but the compressor. It's not so much CNG; it's propane, I think, isn't it? I mean, a lot of or quite a few of the buses and taxis and things in Australia run on compressed gas, right?
I think bus networks do. Yeah, I can't say that I know very much about that.
Taxis have got compressed natural gas too, I think.
And I suspect that fleets in Australia have done the same thing that we have and that we see in Canada. So like utility fleets, for instance, pipelines have probably, the Australian pipeline companies don't y'all think have they operate their service fleets on CNG.
Gas. Yeah.
They can refuel themselves. And so, it makes sense for them to do that.
Right. So anyway, I think at that point, I mean, according to mine, we're at 4:00. So I guess our time is up, and I'd like to thank all the audience who tuned in, and remind you that you can get a recording of the session either from the Centre for Energy Studies or from the IAE website. And with that, I'll say goodbye. And we'll have another one of these actually on Friday. For those of you who are interested, we have another graduate student who's going to talk about renewables in electricity systems. So that'll be Friday. So thank you very much.
Can I just say compliments to Kelly?
Yes.
Great job.
Thank you.
Really great job. And let me just quickly say for the audience, before this, we were talking about her plans after she's done. And she wants to go into the academic job market, but you know what? I'd put you up as a chief economist or chief of strategy for anybody in the industry. Hint, hint, hint.
Thank you. I'll be available in a couple of years.
All right. Well, thank you very much. And I think at that point we might all sign off. And I think they're going to put up a screen sharing for us, right? We've got the people in charge. There we go. Thank you very much.
Farewell.
Farewell. Bye.
Bye.